patient isn't easier. What's the market actually pricing?
Sounds like a little bit of consensus in the word patient. That's for sure amongst the Fed policymakers. The market is pricing patience. You know, if you step back and you look at where rates were at the very beginning of the year, the S&P had a good day and then a very bad day. It's up 13% since the 3rd of January, and yet the 10-year Treasury yield is up 5 basis points. I think that gives you a sense as to the about face that the Fed did and the power of it. You know, we can argue about the box that the Fed may be in here. It doesn't have a lot of wiggle room, but at least for now, I don't know that it really needs it, because at the end of the day, inflation is cooperating. You know, you've got core PCE that's gently below target. It's not in a danger zone in the sense that Europeans are fighting, but it's not, you know, too high either. So the Fed's got some wiggle room here. I think they can afford to sit on the sidelines and be patient.
Dean, what's the relationship between patience and complacency? And particularly patient for how long? It's fine to say till March, till April, till June. What about till December?
Right. No, I think it's a real good point. And this gets back to some of the dialogue that's going on, led by Clarita within the Fed, which is, can we afford to go above target for a while? Let's prove that we can get core PCE, you know, well above 2%, in the 2.5% range before we even worry about anything. And you know, there's been a lot of dialogue about the Fed's sort of about face that they did. You know, it's a significant one. I don't think the Fed has moved so strongly in quite some time, but at the end of the day, it's quite market friendly. You know, we can argue that they move too aggressively, but there's no doubt that it's market friendly. And as we were talking about just before on set, volatility has been sucked out of the market. You see that in rate curves, you know, around the world. Really.
So let's look at that in terms of any asset class. Come inside the Bloomberg, and this is volatility, whether you're looking at FX or treasuries or U.S. stocks or European stocks. It doesn't matter which line is which, because they're all moving down so significantly. Do you want to hedge and buy some vol here? Is there still room to sell it? How do you see it?
Right. So at Macro Risk Advisors, we try to take a process, and you know, it's the case that when markets get very fragile, volatility goes way up. It's when you want to hedge that everybody else does as well, so the cost is very high. Right now, you can look at the S&P 500 and say, okay, you're not in a danger zone at all. You know, you're above that 280 level on the S&P. VIX is quite low. Market's not really moving. So we would say, yeah, there are some opportunities to do hedging. You don't want to overspend, because quiet markets can tend to perpetuate themselves for a period of time. We're trying to figure out what catalyzes markets. It's got to be something. I don't think that's coming around the corner, but you want to be disciplined and you want to be adding to hedges because, as you said, they're so inexpensive right now.
You don't think it's coming around the corner, but we have Fed meetings today and tomorrow. And given where we're positioned right now, I mean, is there any way they can go more dovish than they are now? And doesn't that mean that if there's any risk, it's actually, they might indicate something a little hawkish side?
Right, that's a great point. So I think the market has absorbed all the dovishness that the Fed could provide. You know, so if you look at rate curves right now, there's actually some probability that the Fed could ease next, right? There's no probability that it will tighten. I would say if the Fed actually does ease next, that's not good news for market, right? That's going to be a reaction to something. So the Fed's about face in terms of taking away the tightenings that had gotten embedded in curves as late as last September, that was good news in the sense that they undid some expected tightening. I'd say if the next move is an actual ease, it's going to be in response to global developments, a slowdown in the economy, weakness in earnings, you know, something geopolitical, and I don't think markets are going to react that well to it the next time. So I think your point's a real good one.
So to David's point, to jump off of that, I mean, there is a narrative to be made that the Fed doesn't want the market to be too complacent, because you have low volatility, you're going to wind up taking on more risk, you want to search for the yield, then any kind of change a la Ben Bernanke back in 2013 is going to really shake the market and shake investors out. So how do they get out of complacency but not shock the market?
Yeah, I think the complacency narrative within the Fed comes up and it gets some attention. I don't think it gets a tremendous amount of attention. We're 12-ish years away from the systemic global crisis that was, I think, a real misunderstanding of the risks that we're building in the system. I think a lot of the regulatory initiative post-crisis has done a pretty good job of you could argue that it's a whack-a-mole, right? That you've removed banking system risk, but it shows up in other parts. For example, people have argued, even Janet Yellen has said, the leveraged loan market is something you need to look at very closely. If you look back, for example, in last December, the sell-off in credit was substantial relative to movements in the real economy. And I think that speaks to late cycle fragility. So there are those types of things that are things to be aware of with respect to complacency. I don't think the Fed is going to give it a tremendous amount of attention right now. I think you got to get VIX below 10 to start worrying about it again, at least from the Fed's perspective.